Welcome to the latest in the IMAP series of webinars. It's particularly appropriate for us today to be talking about responsible investing because it seems to me that throughout 2020, issues that touch broadly on responsible investing have been those that have been absolutely central to so many of our clients and so many of our own staff and advice teams. Whether it's been bushfires or COVID or the effects of the recession precipitated by COVID, whether it's issues around Hong Kong and the US trade wars, responsible investing seems to me to have been one of the key themes. Today, we are fortunate to be joined by representatives from two organisations for whom this has been an absolutely central part of their service offer. Stephen Glass from Pengana have been involved for a considerable period of time, and through Hunter Hall, we're one of the originators of responsible investing. And Michael Blayney and Jeremy Dean from Pendal Group, the owners of Regnan, are one of the key RI consulting firms. And we're going to be talking about both international equities and multi-asset class investing. And we're fortunate today to be joined by Doug Higgins from Zenith Investment Partners as the moderator for today's session. RI has been an important theme for Zenith, and I'm looking forward to Doug leading today's conversation. Before I pass over to Doug to kick us off, let me just say a little about the rest of the year for IMAP. On the 27th of August, we'll be announcing the award winners for the 2020 IMAP Managed Account Awards, 5 asset classes, innovation and the licensee category. This year, unfortunately, as with so many other events, we'll be going virtual. So we'll be sending out the invitations to participate in that, 5 p.m. on the 27th of August. Investec, we've made a decision that Investec, which we were planning to hold on the 10th of September, will also go virtual. This is our technology-oriented conference. And then the portfolio management conferences in Sydney, Melbourne, and this year Perth, we're still pending a decision on whether we can hold those live or not. And of course, monthly webinars. Aren't we all living virtually now? So the next webinar is an exciting one for me and one I'm looking forward to. Two of Australia's leading institutional consultants who've both made a significant play to participate in managed account portfolio construction. We'll be talking with Paul Saliba from Evolutionary Portfolio Services about how to bring institutional expertise to advice practices. So that's on the 13th next week, next Thursday. If you have a question to ask, and at the bottom of the screen, you'll see a little Q&A button. Key your question in, and it'll be seen by the presenters. So now it's my pleasure to hand over to Doug Higgins from Zenith to talk to us about how to talk to your clients about responsible investing, to introduce our panelists, and to lead us through the Q&A. Doug, over to you. Thanks very much.
Thank you, Toby. If I can just get you to flick over to the next slide, if you would, please. Here we go. Okay, so good morning, everybody. Welcome to the session. When I started in investment research back in the early 2000s, the concept around things like SRI and triple bottom line accounting in Australia was really a trending topic. And obviously a lot has changed in the last 20 years. Responsible investing is no longer coming. It's here. So to lead off today, I want to try and set the scene. I think the big question for advisors with clients looking to embrace this space is, what are these key elements to consider? And one of these key overarching concepts is really that one size does not fit all. When you think about the landscape, there are dozens, if not hundreds, of values issues that underpin those pillars of ESG. And there are thousands of ESG indices in the market. I mean, MSCI alone has over 1,500 of them. There are a myriad of factors that relate to some of the key central issues across things like climate, sustainability, governance, ethics. So how is an investor to find what represents their values? So then there is the question of, well, how do you even define responsible investing? Now, most commonly, it's typically defined around being the strategy and practice to incorporate ESG factors in investment decisions and active ownership. But the reality is not everybody's definition will be the same. Value is most definitely in the eye of the beholder. So how then are values classified? How are they measured? How are they incorporated? How does the investor identify those key qualities or metrics that they wish to emphasize? There's a lot of third-party ESG scoring systems out there for all the good work that they do. It's not uncommon that they will themselves assume a common set of ESG values across investors. In reality, however, what is socially responsible to one investor may not be to another. So, when we think about then which ESG factors to focus on, investors need to be able to measure the relative value of an ESG metric. But how should that be done? Should it be peer relative? Should it be benchmark relative? Should it be absolute? These are all things that have implications for portfolios. The next question then is, well, how should ESG methodologies be implemented? Again, there are multiple avenues. I mean, should it be a fundamental investment approach? Should it be through the use of an index tracker? Should it be through a smart beta fund? Now, each of these approaches are going to have different implications on, both the outcome that you get and the impact on ESG portfolios, ESG factors in a portfolio. So for many investors, at the end of the day, that acid test will be, can you invest ethically without compromising returns? Now, as with all investment studies, consensus is a reasonably endangered species, but on balance, we believe that a portfolio can definitely be constructed using ESG criteria that is at least capable of equaling the financial performance of a broadly benchmarked portfolio. The key takeaway from that is that when you start to consider longer term risks into the equation, that balance tends to tip more and more in favour of a positive ESG portfolio. The caveat is that those ESG criteria need to be selected really carefully, and the right metrics to identify company performance do have to be clearly understood. Where does that leave us? Advisors need guiding principles. Toby, if I could get the next slide, please. So look, in the early days of ethical investing, there was really only one key approach, and that was avoidance. People said, okay, let's work to eliminate exposures to those sectors or activities which are seen as harmful. Over time, that then subsequently evolved to include essentially agenda advancement. Let's focus on being able to align capital with positive activities, behaviours or outcomes. But these are still very broad aspects. So there's a large number of managers out there which are essentially ESG aware in some form. They think about responsible investment principles. They tend to have some elements of negative screening, often based on the classic sin stocks. But on the whole, these aspects may not necessarily be systematic through the process or radically reshape their portfolios. You do then also have managers who take a more integrated approach to responsible investment. They go further. They'll typically have explicitly stated RI commitments in their objectives or policies. They'll pay attention to these principles. It's usually systematically applied throughout the investment process. They also tend to have fairly highly active corporate engagement and action policies. But within all these aspects, there's graduations between them. Many funds will just choose not to take into account ESG principles. Instead, they're going to be utilising different investment objectives. Others, like impact investments at the far end of the scale, they're going to be seeking to make specific, measurable, real-world changes. But these distinctions can be nuanced. The lines can be blurred. For us at Zenith, at the moment, we are working on giving advisors more tools to help guide these decisions. We're currently in the process of rolling out a framework to provide our clients the ability to better identify how these managers use and incorporate ESG into their processes. And we look forward to bringing more details to the market on this initiative in due course. Okay, from me, the scene is set. Let me introduce our speakers today. First up, we have Stephen Glass from Pengana. Stephen is the Deputy Portfolio Manager and Analyst across a range of Pengana's main equities funds. He has over 20 years experience as a PM and an equity analyst. Prior to joining Pengana, Stephen had 7 years at Hunter Hall International as an analyst and a PM, and prior to that worked as an equities analyst at Tricom Securities and also at Platinum. Also up, we have Michael Blayney and Jeremy Dean from Pendal. Michael joined Pendal back when it was BTIM in 2017 and leads the multi-asset investments team. He has over 22 years investment management and consulting experience, and joined Pendal from First State Super, where he was head of investment strategy. Jeremy leads Pendal's responsible investment distribution strategy across institutional, wholesale, and for-purpose clients. He seeks to work closely with the investment boutiques and Regnant Advisory to deliver client solutions that meet both investment outcomes and sustainable goals. With that said, Stephen, I will hand over to you.
Hi, thanks for that, Doug. I think most of what needs to be said has been said. That was a fantastic introduction. I'm Stephen Glass, Deputy Portfolio Manager of Pengana International Ethical Fund and its listed peer Pengana International Equities Limited, which trades under the ticker PIA. These funds were previously managed by Hunter Hall, and my team took over the management of the funds 3 years ago. So the funds have a long and storied track record in the ethical investment space. But the relevant track record for the current investment team commenced in mid-2017. Today, I'm going to discuss our experience of managing ESG funds with 3 key points. Firstly, I'll begin by explaining what we are seeking to do, which is essentially to ensure both ethical compliance and financial objectives. Secondly, I will describe the evolution of our ESG process, which touches on the great strides the industry has made and is likely to continue making going forward. Finally, I'll discuss how it fits into our return goals. After all, ESG investors are also seeking returns. At the end of the day, the discussion is really about the industry's journey in this exciting and growing space called ESG investing. We have done a lot of work in this space, and I am hopeful that there will be some meaningful takeaways for your clients. Next slide, please. We are very serious about investing. Outside of looking after one's loved ones or their health, we think managing someone's life savings is the next most important thing in a person's life. And when I say we, I mean, when I say we do such important things, I mean you as a financial planner and me as a fund manager. When people give us money, they're entrusting us to fulfill a certain role. From this vantage point, the single most important thing for a fund manager to do is to do what we say we are going to do. When someone gives us money for ESG investing, they don't expect a high-performing fund that invests in tobacco, and nor should they expect a low-performing fund filled with green energy. The role of an ESG fund is to target both returns and ESG compliance. This is so important, I will repeat. It is critical for an ESG fund to deliver both solid returns and ESG compliance. Next slide, please. Our team have always believed in ESG investing. A shareholder is an owner, and we don't want to own things that contravene our ethics. There is no difference between owning a private business and a public business. If you had $100 million to invest in a business, would you be comfortable building a private business that manufactures bullets or tears down natural rainforest? The Pengana International Ethical team certainly wouldn't. And given we wouldn't do it for a private business, we certainly wouldn't do it for a public business. I remember as a first-year analyst being asked by my boss to look at a US defense contractor and having to explain to him that I simply could not do that. Over the years, we have always shunned companies involved in industries such as gaming, animal cruelty, environmental destruction, tobacco, or human rights abuses, among other industries. So when Pengana acquired Hunter Hall, we figured it would be easy for us to manage a dedicated ESG fund. When we took over management of the Hunter Hall funds, we made some changes to enhance its ESG credentials. We exited all the gold positions that Hunter Hall previously owned, and we implemented Sustainalytics to help provide ESG research. We were proud of these changes, and as we travelled around Australia communicating them to the Hunter Hall unit holders, we were expecting pats on our backs. That is not what we found. We were criticised for holding Heineken and Rio and for damaging the environment by flying around Australia. This led to some soul searching. Were we really doing what we said we were going to do? The thing with ESG investing is it means different things to different people. I don't have an ethical problem with brewers, and I figured Rio mined critical commodities and was exiting coal and was highly rated by Sustainalytics. However, many people did have problems with them, and they did not expect to see those companies in an ESG fund. We had to respect that and resolve these issues to ensure that we were delivering exactly what we said we would deliver. Next slide, please. As part of the resolution, we used some external help, and we hired Australia's leading corporate ethics consulting firm, the Ethics Centre, to conduct a multi-month study of the Australian ESG market. This slide forms the core of a lot of their work, and you might find this particularly useful when you talk with your clients. I know it's difficult to see in the slide, so I will give a brief explanation. Each column points to a different area of ESG investing, starting with ESG integration on the left and moving towards impact investing on the right. The rows along the bottom provide the characteristics of each type of ESG investing. The orange bar at the top talks to returns. It crosses virtually every column, highlighting the importance of returns. The blue bar talks to managing ESG risks, which for the most part rarely means avoiding the bad stuff. The green and aqua bars talk to actively seeking positive impact companies, and the red bar calls for measuring and reporting the impact of the investments. Pengana International Ethical currently sits in the positive or best-in-class column. You can see we've circled it in green. We are always seeking competitive financial returns, and I'll have more to say on that in a moment. We also avoid all the banned activities, including casinos, animal cruelty, pornography, human rights abuses, weapons, logging old growth forests, and following the Ethics Centre guidance, we also avoid all alcohol and all minors, as well as some other activities. As part of the banned activity process, we considered a materiality clause, which speaks to the percent of a business that can be involved in a banned activity. We regard any participation in a banned activity akin to an investment error, and we are targeting a zero error outcome. We've actually allowed ourselves, we've communicated to the market a 10% threshold in order to give us some leg room in case we miss something and it just slips past us. So we can ensure we are always doing what we say we're going to do. So as it relates to materiality, I think there should be some leeway because things can slip past, but the ultimate objective should be a zero exposure to banned activities, and that's where our fund stands today. The yellow and blue bars speak to ESG investing as it historically was, and as we move down to the green and red bars, we visit the evolution of modern ESG investing. I might start by skipping the green and aqua and moving straight to the red, which, as you might recall, is the measurement and reporting of impact investing. Measurement is an area that is becoming increasingly relevant. The challenge we face is that not all companies report their ESG factors, which means we are not currently able to report it across our portfolio. So while we can report ESG factors for some of our portfolio, we can't report it for all, which means it would be disingenuous to claim that we have fully satisfied this element of ESG investment. However, we are working to resolve this. This brings us to the green and aqua bars, which talk to investing in positive impact companies. I regard this as the most interesting and challenging development in modern ESG investing. Investing without constraints is challenging. Ask yourself, how many fund managers who don't have ESG constraints consistently beat the benchmark? Not many. Adding positive impact companies does not make things much easier. The difficult part is not finding the positive impact companies. That is straightforward, and during a bull market, you might even perform well from a random selection of them. The challenge is finding enough of them to create a portfolio that will satisfy our financial objectives and deliver across market environments. Our approach to positive impact companies is evolutionary rather than revolutionary. We simply cannot identify enough positive impact companies to completely fill our portfolio and deliver on our financial aims. This does not mean we can't find any, and we have been investing in these companies when the opportunity arises. Next slide, please. One example is Vestas Wind Systems, which is the world's largest wind turbine company. Wind energy is clearly on the right side of the ESG ledger, and Vestas is also on the right side of the financial ledger. Its scale allows it to outspend its peers on R&D, and Vestas has the best reputation in the market. It generates approximately 40% of its EBIT from aftermarket service, which is stable and high margin. It has a fortress balance sheet, reasonable valuation, and its future is secure. Vestas is the exact type of company we are happy to invest in. Some other areas we have found where we have found suitable investments include healthcare, where we have invested in Novo Nordisk, the world's largest manufacturer of diabetes treatments, and sustainable packaging, where we have invested in SIG Combi Block, which manufactures recyclable paper-based packaging that can be used to replace plastic packaging. Next slide, please. However, there remains a raft of areas we are looking at but have not yet identified suitable candidates, including solar. The problem with solar is it's generally a commodity business with low barriers to entry, meaning the companies are generally lower quality and do not fit our quality requirements. Recycling. The largest and best play is Tomra Systems, which makes machines for recycling waste, but trades on an astronomical valuation. Electric vehicles such as Tesla and Nikola, again, and manufacturers of lithium batteries. Again, great companies, but trade on very rich multiples. Education. The problem with these companies, they're often low quality businesses because they are entirely dependent on government funding. And we don't like those kind of businesses where you've effectively got one client. Financial inclusion, the best player is probably M-Pesa, which is majority owned by Safaricom, the Kenyan telco. The primary issue here is the illiquidity of Safaricom, with daily average trade volume of less than $500,000. I could go on, but the key point is we are scouring the world for positive impact companies, and when we identify the ones that fit our financial objectives, we will act. So the key messages I want to leave with you regarding ESG compliance are, it is constantly evolving. It is not good enough to just have a negative screen. You need to work towards reporting the ESG factors and increasingly invest in positive impact companies. However, you should not just fill up a portfolio with positive impact companies without regard to financial objectives. And the best way to progress with positive impact companies is to gradually add them to the portfolio when the opportunities arise. Next slide, please. Now that we have established what ESG compliance involves, we must consider the financial objectives. The Pengana International Ethical Fund's financial objectives are threefold, all of which are equally important. They are to make money, to minimize drawdowns, and to minimize volatility. And the way we go about delivering on those goals is to invest in a diversified portfolio of highly cash flow generative companies that are growing, reasonably valued, and are unlikely to blow up. I could spend a whole other presentation talking to these objectives, but I won't today because today's focus is on ESG. The only point I want to make is that for us, ESG compliance is the start, but it isn't the finish. We need a highly diversified group of companies that fulfill several criteria. And given the constraints created by these criteria, we need a large investment universe. This is part of the reason we invest across the world, from small caps to mega caps, emerging markets to developed markets, from Japanese internet conglomerates to US health insurance, Indian cellular companies to Danish turbine manufacturers, German derivative exchanges to Swiss sustainable packaging companies. Next slide, please. And we have found that this strategy works. In the 3 years since we have managed the Pengana International Ethical Funds, we have incorporated what we think is a market lead in ESG framework, which has avoided all companies that are harmful to the world, whilst adding positive impact companies whenever the opportunity arises. This has not come at the expense of returns, as our fund has delivered 10.7% per annum since we launched it, with an 8.5% standard deviation of return, both of which compare favorably to the market. And critically, we have also saved money when it counts. Next slide, please. This slide shows our performance and the market performance during the 2 week quarters since we have managed the funds. The grey line is the market and the light blue is us. And you can see that in both times the market collapsed meaningfully, we outperformed meaningfully. So in the recent COVID decline, the market was down about 10%, we were down about 4%, and you can also see that our beta is less than the market. So it is possible to provide an ESG compliant portfolio and deliver on financial returns. Next slide, please. Today, I explain the importance of doing what we say we're going to do. For us, that means providing an ESG compliant portfolio that also delivers on its financial objectives. This isn't easy, but it is possible, and we have done it. I'd like to leave you with a quick story. A while ago, I was interviewed by a global major financial TV network. They asked me to give me my view of the funds management industry in one word. I answered, good. They shook their heads and they recognized that maybe they should give me a retake and ask me and allow me a few more words. So they asked me again, how would I describe the financial services industry? And I said, not good. You could see their frustration, and they were starting to think, well, maybe this isn't the right guy to interview. And so they said, okay, we'll have a few more words. And then they said, okay, try again. And I said, not good enough. The issue is that too many people focus on just one thing. It could be point-to-point returns, it could be capital preservation, or it could be ESG compliance. That is simply not good enough. And as an industry, we need to move to a more comprehensive solution, which means ESG compliance, delivering solid point-to-point returns, minimizing drawdowns, minimizing volatility. I think that is fair for you to expect from your fund managers, and that is certainly our goal. Thank you very much.
Excellent. Thanks, Stephen. Look, we're going to roll straight into the next presentation from Michael and Jeremy. Thank you, guys.
Thanks very much, Stephen. Thanks very much, Doug. Thanks, everyone. So I'll just take control of the presentation. Okay, so my name's Jeremy Dean. I look after responsible investment distribution, and to my right, or to your left, socially distanced, is Michael Blayney. Michael heads up our multi-asset team, and we manage sustainable multi-asset portfolios in-house. We also provide some management, strategic asset allocation, and consulting externally for a number of wealth management firms. We'll spend the next sort of 10 or 15 minutes talking about how to speak to clients about ESG. And obviously use the chat, and we'd love to ask or answer any other questions. From my perspective, this is a really challenging conversation, and I think we're still very much at the beginning of how to talk to clients about ESG. Stephen and Doug mentioned before that there are multiple definitions. There's multiple different ways to think about it. One person's values are different to another person's, and we're combining values and value, which from a portfolio management and an advice perspective can become very challenging. I think that is also the opportunity. How do we form a deeper connection with our clients, whether it's a retail, institutional, not-for-profit, for-purpose driven client, and deliver beyond that fundamental need of investment returns. And how do we uncover the motivation and that sort of the power of values, but doing that in a way that is accretive to the investment performance. I think also we need to recognise the impact of some of individuals' behavioural biases. Where there is an event or a specific issue. Obviously, that's very emotive, and we need to try and help investors to make deliberate decisions based on that information. We've been having conversations late last year around particular failures in the financial services industry. An example with regards to Westpac, a significant breach of AML, 25 odd million potential breaches there, and this for many people. The failure of this was sort of a failure of a core part of what they believed in. Before that, Westpac was known sort of globally as one of the most sustainable organisations and sustainable banks. 200-year history, part of the DNA of the Australian fabric. And there was this breach, this failure of something that we sort of held sort of true and constant. And we had clients ringing us up, in our managed portfolios and saying, what are you doing about this? And when are you selling? And it was a really sort of interesting sort of dynamic, right? Something bad has happened, and the natural result is to want to sell, to want to be seen to doing something, and that's okay. There are we need to sort of satiate some of these needs, but in many cases, like most examples in investing, you're often best to pause and consider what is it that's happened. What's the I don't like the sort of concept of materiality from a values perspective, but what has happened? Should it have happened? Should they have known about it? What are they doing about it? What's the end impact of it, below the headline? And how does this actually impact the valuation of a company? And all of those things sort of mixed together. And I'm not sure that there's a right answer, but definitely we can provide a framework for investors, advisors, portfolio managers, and so forth to be able to make that decision. In some of the funds that we manage here, we sort of call that out as a material red flag. And so, our own guidelines meant that we had a period of time to sell that. In some of the other funds, the preference there was absolutely around engagement. So we need to sit down with senior execs, the board, and so forth, and actually understand what's happened. Was it deliberate? Was it underinvestment? What does this actually say to the health of the organisation, and so forth? But what I sort of find interesting is that that connection between the emotive piece of something happening and the desire to do something or to not do something. So, the point of raising that is it's complex, and we need to, collectively, I really like Stephen's point, collectively we sort of need to rise and sort of try and solve some of these things. How do you talk to clients about ESG? The advisors on the line, are arguably best place to do that. They do this day in, day out. This is more than just values. There's obviously an opportunity to talk to people about values and how we drive that. But for me, it's about case studies, it's examples, it's test cases. And I think where we need to get to as an industry is to be much better about how we articulate some of these things. There's no such thing as a perfect company, and there are sort of shades of green about how some of these things are implemented. So the challenge there is to provide sort of insightful, meaningful, arguably succinct information to yourselves and to investors to be able to to consider this. How do I feel about mining? Well, how do I feel about the inputs into electrical cars? Who are the better miners relative to the poor polluters and so forth? So I don't know that it's an absolute. The challenge is for PMs and the ones making decisions is that they need to make a decision of buy, sell, and hold. I think a number of the sort of key points have been covered by both Doug and Stephen. So I might just whip through to a little framework that I've sort of been working on. Obviously, these slides will be available post. But this is sort of a guideline that I've been using with advisors. Use it, pull it apart, pick holes in it. But really, it's sort of identify the objective. What is it that we're trying to achieve by investing sustainably? Is it a feel-good sort of factor? And there's absolutely nothing wrong with that. And so maybe the client might be more sort of towards the impact sort of style of investing. Is it an opportunity for advocacy? Is it I actually want to own a poor-performing company so that I can participate in voting, so that I can actually participate in the engagement and the discussion? Or do I just want to simply avoid? And all of those, again, are sort of appropriate depending on the approach. We, collectively as an industry, need to be able to provide, as I said, insightful, succinct information that allows people to make a considered decision. It's not easy. It is not easy. And from a sales perspective, I need more infographics and short videos and things like that to be able to have a better conversation. There's different ways of implementing this. Absolutely, some asset classes lead to better implementation through a managed fund or a direct equity SMA and so forth. The challenge here, we'll talk about this with Michael in just a moment, is how do we combine this up to a multi-asset portfolio? How do we get sort of consistency across asset classes? Again, I think scenarios and what if questions. What happens if there is a failure of governance? What happens if a company that acquires another company that has exposure to the paper manufacturing that goes into tobacco packaging? How would we feel about that? And the hard thing is then we need to make a decision. And otherwise you're just investing in cash. So we need to make a decision. We need to pull the trigger, and then we need to measure. And this is all part of, I think, a good sort of investment philosophy. But we are just introducing some non-financial components to it. And I think the real opportunity collectively for us and advisors and clients is it's a rich conversation. I'm not sure, as I said, there's sort of right answers in at the extremes, but it's a richer conversation. It's driven by emotions, and the challenge and opportunity for us collectively as an industry is to sort of is to deliver the returns, but do that in a way that at a very bare minimum recognises the impacts or avoids the harm, but ideally where we can allocate to some of those positive companies. So with that, I might hand over to Michael and happy to take questions.
Thanks, Jeremy. So I think it's useful when thinking about constructing a portfolio. Now, in this context, what we're talking about is a diversified portfolio or multi-asset class portfolio. There are a few key issues to overcome, a few things that come up when you start to think about implementing a sustainable portfolio. Now, the first one is the highest level decision, which is the asset allocation. And the question there is really, well, does a focus on whether I call it sustainability or SRI, does that cause you to lose some diversification between asset classes because some of the asset classes might not be able to be implemented in a form that's consistent with the desired belief set of the end client? The next part of the decision is, well, getting on to more of the implementation, is the manager selection decision. And the key issue there is really, well, any other sort of normal manager selection decision, there's a universe of tens, potentially hundreds, sometimes even thousands of underlying products and managers to pick from. Whereas historically in ESG land, there was a much smaller number of products to pick from. And this was certainly my experience, 20 years ago in my sort of former life as an asset consultant advising charities back then, who were the main users of back then screened portfolios, was that there was certainly a give up in manager choice, which is not so much the issue, as much of an issue now. The final element then, if you sort of take your top line asset allocation, you move down to populating that with managers or portfolios, the final thing is then within each asset class, does the impact of negative screening result in either lower performance or more risk? The sort of historic argument was, well, you screen out part of an asset class, that results in a smaller opportunity set. Does that mean, therefore, that you'll either get less return because of that smaller opportunity set or less opportunity to diversify? And I'm going to talk a little bit about that in a minute. So moving on to a little bit more of the detail. Sort of looking at it on an asset class by asset class basis. Now, what I've picked here is by no means the full suite of asset classes that you could potentially put into a portfolio, but I think it captures the broad choices available to investors. Now, the first cab off the rank is always Australian equities. The good news of that is there's actually plenty of choices. In fact, there were plenty of choices in Australian equities 20 years ago. So then really when it comes down to the issues are really working out, well, aside from picking a fund manager who can add excess returns over the long term, well, where do I want to be on the spectrum? There are deep green product, which screen out a very large number of holdings in the market, and there are lighter green sort of, if you like, best of sector products would have been the language we would have used 10 or 15 years ago, which screen out a lot less, but then have to make obviously some compromises around what they invest with, and not every end client will be comfortable with that. One of the challenges with the Australian equity market, and this kind of applies generally anyway, but it's amplified when you start to have a screened product, is that the market itself is relatively concentrated to begin with. So if you start to screen out a lot of things, then you can potentially finish up screening out, quite a bit of the universe, and potentially exposing investors to some, additional risk. Excuse me. The next one is international equities. Historically, that was actually quite difficult to implement, but over the years, the number of managers and products has increased very significantly, and now there is a lot more choice for investors with international equities. The two biggest gaps still, though, are around currency hedging, because as international allocations are increased, usually there'll be a desire not to continue to add additional currency risk, and so it can be helpful to have some currency hedged products in the market as well as unhedged products. Now, this is particularly a case with screened investments, because due to the, if you like, loss of diversification in Australian equities, it may make more sense to have a larger global allocation in some screened portfolios. But that will be case by case and very much depend on, how green you go, how deep that screening goes in the Australian equities. The other sort of still relatively undiscovered country is emerging markets. There are some products offshore. There's even some passive ETFs that invest in screened emerging markets, but at present choices there are a little bit more limited. So you can certainly get enough diversification, but a couple of implementation things, if you're using managed funds or ETFs, can be a little bit more challenging. We run sustainable multi-asset class portfolios, and that enables us to use derivative overlays, which make it a bit easier to solve some of these problems. But look, nonetheless, none of them are a deal breaker in portfolio construction. You can certainly use the funds and tools that are out there to construct a very good portfolio. Property is one where you don't have a lot of, if you like, green labelled product. However, it is an asset class that's actually quite green, and that's because I think the managers of REITs realised very early on that actually it was a great intersection of good business sense and good environmental credentials. Basically have lower power bills, have buildings that are more appealing to tenants, and that's incremental to value. So, and REITs were actually one of the earliest examples of a win-win from integrating sustainability. So whilst there aren't necessarily screened products available, generally, certainly I find talking to clients, most clients don't have a particular issue around REITs, either Australia or global, and so they tend to be less of a problem. Infrastructure is an interesting one. Now, in this context, I'm talking about listed infrastructure, obviously given the audience today. I guess what I would say is at this stage, there's very little dedicated sustainable listed infrastructure product available. What you then need to get into is, and this comes down to sort of how investors want to position themselves, how they want to think about this in a portfolio, is that when they look down the holdings, there will be some asset types which will actually be extremely green. You can potentially have listed renewables in one of these portfolios. Equally, there might be things which are large emitters. You might find a ports company which owns coal ports. You might find airports, for example. You might then find toll roads, and toll roads could actually be quite complex, because you could say, well, on the face of it, yeah, lots of cars polluting as they drive down the toll road, but if that toll road happens to be full of electric cars, not such a problem. And so that's an example of where it can be a little bit nuanced and complicated. Moving on to sort of liquid alternatives. Now, liquid alternatives are one which are a bit of a difficult one to define. In many ways, the best definition I've ever heard is actually Jeremy's definition, which is anything which is not a bond or an equity is basically an alternative. It's actually that's the most workable definition that I've found. So in that, you can include things like long-short funds. You could even include funds with, like target return, real return style strategies, even though they do have equities and bonds underneath them. The ways that they use them are quite different to a traditional long-only fund, and their use of, for example, alternative strategies, derivatives, etc., tends to be more. Now, liquid alternatives have struggled of late. It's been a very difficult environment for a lot of active in general, but particularly because liquid alternatives tend to have more of a quantitative flavour to them. Things like particularly the value style of investing, which a lot of quant strategies tend to use, has struggled. And even some of the other quant strategies like trend following have also struggled because of the, if you like, the whipsawing environment that we've had and the central bank interference we've had anytime markets take a bit of a dive. I will talk a little bit more about why we think alternatives make sense in a portfolio in a minute, but just kind of flagging, look, it's an area which some clients have struggled with because I think there's a lack of, in some cases, there's a lack of transparency. We think that's pretty easy to overcome for a fund manager, just being more transparent. But the other element is, well, is there much in terms of sustainable product out there? And we've recently converted one of our liquid alternative strategies into a sustainable fund. And that was actually in response to a lot of client feedback that was a good thing to do. And also that we think it's really good from a returns perspective. And that's kind of on my last slide, so I won't do a spoiler on that one. Fixed income, interestingly, again, that's evolved a lot. 20 years ago, when I was, advising charities, it was about kind of, well, just don't have any credit, you'll be okay, just put in government bonds. That's evolved massively. So you've now got a real recognition that, particularly through the corporate exposures, that you can help to support a sustainable future, both in terms of, if you like, supplying funding to good things. You've seen the issues of green bonds, you've also seen social impact bonds. And in many cases, whilst people may have concern, well, what does this do to the risk return? The fact that often a bank will sit and be essentially back-to-back with the borrower means that the credit risk in many issues is actually to the bank rather than to an end social project. And that has actually helped investors get a bit more comfort with the asset class. It does, however, come with a bit of an associated issue, which is to do with banks, is that how comfortable are your clients with exposure to those banks? Because, ultimately the issuer will be the bank. You'll be able to point to the underlying project that's being funded, and different clients will have different views on that. I've certainly got different feedback from different clients on that. Some look at the end social impacts of an impact-orientated portfolio, and get a really good vibe and a really good feeling from it. Whereas I have had somebody else look at me and say, seriously, Bank X, I won't say the name, you have that in a sustainable fund. So, you can very much get different views on that. The other element within fixed income is once you go beyond developed markets, getting into emerging markets can be a little bit more challenging because a lot of the issuers are oil-rich countries, so not necessarily keyed in with sustainability. You also potentially get issues around human rights, and that can be a very significant issue, particularly since in emerging markets most of the bonds are still sovereign bonds, and so you are issuing to certain regimes that you might not be comfortable with. So that's, EMD can be a little bit harder, but it is a niche asset class for investors, so it's not a big give up. The final element is on the cash exposure, which ultimately just comes down to how your clients feel about banks. Sorry, I should move on. We're just trying to get to the next slide there. Look, this is our forward-looking risk return assumptions. Basically, you've got your return on the y-axis and your risk on the x-axis. What you will be able to see when it comes back on the screen is that this is our forward-looking assumptions. They're over 10 years or more. They look more at, if you like, secular long-term growth rates for equities rather than being any sort of short-term forecast. However, they are obviously sensitive to the starting point of very low cash rates, very low rates on fixed income. Now, what this illustrates is actually we think over the long term, equities are fine. They're, you know, whilst you have a fair bit of short-term downside volatility to cope with, they tend to generate the, you know, those good returns investors are after. Most clients, though, don't want a 100% equity portfolio. They do want something a bit more diversified, and that's where the real challenge comes in. With cash and fixed income being on such low yields, ultimately, whilst, you know, you can get a much better return on a bond than its yield when interest rates fall and the prices go up, over the long term, those bonds do eventually mature. And so whilst you can get some enhancements from all the technical things that bond managers will talk about to do with, you know, a little bit of extra carry, roll down, so on, and those things are valid sources of returns, ultimately low yields does mean low prospective returns. And that's why we believe that for investors who can't tolerate the volatility of having 100% in equities, that an allocation to alternatives makes a lot of sense in a portfolio, effectively funding some of that by reducing a bit of equities and a bit of bonds to give more balance in a return in a portfolio. Moving on. Next one. Sorry, we're just having a few technical issues changing slides. So I guess the key thing here is that the implementation options have been expanding. And, you know, also obviously at Pendal, we're an active fund manager, but we do realise across the whole industry, there are a range of different products, a range of different providers and solutions, and it can make a lot of sense for an end client to use a blend of all of these things. Now, within active, there's always been managed funds, and they continue to be a great way to access sustainable strategies. There has also been the emergence of SMAs, which for clients who want to be very engaged, have that additional transparency, can be a very, very good solution as well. In alternatives, it's very early days. We're quite proud to be on the early part of that journey because we think that's a really important thing for client portfolios and a really important thing to be able to be in a sustainable portfolio. But we are starting to see products emerge there, and I think that's really important. Much like we saw, you know, moving from no fixed income products to sustainable fixed income products being available, that's been a really good move. The final thing is just the growth of ESG indices. Now, obviously, there are pros and cons of index approaches to ESG, but they do facilitate a number of important developments for clients. They facilitate the ability for ETF issuers to come out with bond and equity ETFs, which give more options for implementation. And particularly if you're wanting to take a tactical position with a client portfolio, trading an ETF can be a much better way to do it than trading in and out of a managed fund. Also, the other element that's perhaps less relevant to a separately managed account, but is exciting to us as multi-asset managers, is the rise of ESG index derivatives. So these are futures, rather than being over, say, the S&P 500 or over an S&P 500 ESG index. Or even in credit default swap land, which is a way of getting derivative exposure to credit. Historically, people traded indexes of CDS. There are now ESG indexes of CDS becoming available. And we're finding some of these tools are actually really useful in our alternative strategies. Moving forward. So this is our last slide. We're almost at time for the presentation. I think the key thing though I wanted to leave though is really in today's world, there is no need to sacrifice returns or increase risk by moving to a sustainable implementation. There's now a vast body of academic research, and we were looking at this recently, and there's in fact so much academic research that there's people writing papers which simply review other papers, and they call them meta-studies because there are so many thousands of papers out there on this topic. I just took a screenshot, referenced it at the bottom there from one of those papers, this was really just a tiny subset of the studies that have been looked at, and without going into all of them, is basically there are these studies which look at, you know, E on its own, S on its own, G on its own, and generally the findings are either neutral to positive. And so that's across the board and very consistent. And it's consistent across E, S, and G. So all these dimensions adding value. Now, the other element of that is it's not just about good ESG, but also about improving ESG. So like many factors, you can find good leads to outperformance, but so does improving, even if that improving is off a low base. And that's an important nuance to be aware of and to think about. Now, the final points I just wanted to make is that, you know, with screening, what we call typical institutional screening across very large universes should reduce the allowable universe by 10% or a bit less. Now, obviously, you can go deeper green and reduce it a lot more, but ultimately, for a good active manager, that still leaves you with a vast universe within which to build your portfolio and build a good client portfolio and get the diversification. There's very much a growing range of implementation options, which is a fantastic win for investors. And now you're seeing, you know, ETFs to give additional choice. You've already got share funds giving choice, and now we're seeing a move into alternatives as well. And the final point that I wanted to leave you with is, you know, you've seen this academic research which looks at the past, but I think the really exciting part is the future. And that's, you know, we're seeing a greater focus from regulators, from stakeholders, from customers around sustainability. And so that creates a mega trend. And for client portfolios to be positively exposed to that, even if it doesn't, you know, you might not see a payoff over 1 year or 2 years, but ultimately we're, you know, clients in equities with diversified portfolios, they're long-term investors. And, you know, if you say, well, I've got a 5, 10, 20-year time horizon, having a positive tilt giving you that tailwind of returns from sustainability is a great thing for a client. So that's all. Handing back to Doug.
Excellent. Thanks, Michael. Thanks, Stephen and Jeremy. That's been great. Look, we've had some excellent questions coming through the chat. The guy's been busy hammering out a lot of answers to those. Toby has said to me that if there are any other unanswered questions that come through the chat, we will look to post some answers later on. But look, I thought a really good one that came through here was asking around the consideration to net positive or net negative impacts. So, you know, how do you weigh up potentially, you know, the impact of a bad company coming in that might necessarily have still some positive values? Do you try and balance those out, or does it become much more case by case specific in terms of, you know, running a negative screen?
Okay, should I start with that, Doug?
Yeah, Stephen, by all means.
Sure. So, look, at the end of the day, and that does actually speak to the materiality clause that we discussed. We start with, if companies are involved in banned activities, then they're actually banned. So even if they're doing things that might offset that, our view of our research in the market is that isn't what people are looking for when they invest in ESG funds. And we are always eager to deliver what we say we're going to deliver. As well as that, it's also our own guidance. If something is banned, I don't think, in our view, if you're doing, the short answer is no, there's no net in, really. And if you, in life, I don't think if you do something bad, you can offset it necessarily by doing something good. So it's not like this ledger that we have. The start of this, of ESG investing for us was really about banned activities. And so that's the first filter. And really, if it doesn't pass through, it doesn't pass through, even if it does lots of good things. Now, having said that, like all things with ESG investing, there's nuances. So for instance, this sustainable packaging company that we invested in, it is at the end of the day involved in paperboard, and paperboard is not wonderful for the environment. However, they do it using sustainable plantations. They get very good scores. There's no old rainforest growth, old rainforest is being logged, and the net product is very good. So whilst we'd have to say they've got parts of their operations which aren't great, there is nothing there that's banned, and the sum total is to actually develop something that's good. And so therefore we think it's actually a positive screen. So if things are bad, can't make it through, but if things are okay to good, it does mean they can be positive screen in our view.
Yeah, I look, sort of echo as Stephen said, that like, it's a difficult one. And again, this is where the sort of rubber hits the road. This is the sort of nuancing of it. You know, AGL constantly comes up. So you know, one of the largest polluters, the ASX 300, but also one of the largest investors into renewable energy. So, you know, I mentioned before, you know, this is an opportunity to sort of talk to clients and say, well, how do you actually feel about this? And, you know, ultimately you need a sort of rules that can, whether it's materiality of revenue, whether it's intentionality. Are they? What is the direction of the business? Is this something that they're heavily investing more and more into fossil fuels? How do we actually, they've come up with a statement to say that they'd like to be renewable energy focused in a number of years. How do we measure that? How do we make sure that they're on track? It's nuanced. It's hard. I think again, you need to look at what the intention of the portfolio is. We, for some of our funds, provide sort of a summary of what the CO2 emissions are for that particular strategy. So if you're the PM, you really might like the stock, but what's the implication to the total portfolio of actually holding that? But then also, exactly to Stephen's point, is this what the investor would expect to be held in the portfolio? And I would say having a very large carbon emitter in a ESG portfolio, would certainly make my role a little bit more challenging in the ability to sort of articulate, the rationale of doing that. That being said, we still need to focus on the job.
Yeah. No, look, thanks for that. Look, unfortunately, we've hit the 1 o'clock mark. As I said, we're going to try and get answers to these questions back to everybody. But thanks, guys, for all of that. That's been really interesting. Toby, I'll hand back over to you to wrap up.
Doug, thanks very much. So, Michael, Stephen, Jeremy, thank you very much for your time, all of you. It's been very interesting. There were a couple of questions I was looking forward to getting to, which we didn't make. One in particular concerned countries that might have policies that we don't agree with for reasons of corruption or authoritarianism or anti-democratic behaviours, and how does that affect our view of the companies that originate in those countries. As Doug said, we'll be sending out answers to all of the questions that have come up to everybody who attended today. So thank you very much for your participation, everybody. Just one quick reminder that next week we'll be bringing the next of our webinar series to you on bringing institutional expertise. The interesting thing about this will be case studies. We'll be talking with both Rebecca and Michael from Mercer and Jana, respectively, about live examples of institutional asset consulting applied in retail advice. That's been one of the strengths of Zenith, of course, Doug, and it's part of the professionalisation of the advice industry. So thanks for joining us today, and we'll look forward to talking with you again next week. Thanks very much.
Thank you.